Hello, how are you today? How did you find the first module? I told you it is not so intimidating after all. Were you able to do your own research? Okay, let us compare notes. Welcome to the Responsible Traders POB. These are my notes, my own additional research and studies on the topic that I posted, and my personal observations and opinions that I am sharing with you to further enhance our knowledge and understanding. Some of these were previously posted on the Responsible Trader thread in Stock Market Pilipinas. This is the latest version of the previous post I made. Some of these, plus further explanations and discussions, will be appearing in my forthcoming book, The Responsible Trader. Module 1, Technical Analysis and the Dow Theory. The Dow Theory. Any attempt to trace the origins of technical analysis would eventually lead to the Dow Theory. While more than 100 years old, the Dow Theory remains the foundation of much of what we know today as technical analysis. It is generally recognized that technical analysis started with the work of Charles H. Dow. This is the same Dow who teamed with Edward Jones and still remembered in the name of one of the leading stock market indices, the Dow Jones Industrial Average. Dow and Jones founded their business, Dow Jones and Company, in 1882. They started by distributing a small handwritten newsletter to banks and brokerages. It was called the Customer's Afternoon Letter. It became the Wall Street Journal later on in 1889, and Dow continued as its editor. The Dow theory was formulated from a series of Wall Street Journal editorials authored by Charles H. Dow himself from 1900 until the time of his death in 1902. These editorials reflected Dow's beliefs on how the stock market behaved and how the market could be used to measure the health of the business environment. Due to his death, Dow was not able to publish his complete theory on the markets, but several followers and associates have published works that have expanded on the editorials. Some of these are William P. Hamilton's The Stock Market Barometer in 1922, Robert Rees' The Dow Theory in 1932, George Schaefer's How I Helped More Than 10,000 Investors to Profit in Stocks in 1960, and Richard Russell's The Dow Theory Today, 1961. Dow believed that the stock market as a whole was a reliable measure of overall business conditions within the economy, and that by analyzing the overall market, one could accurately gauge those conditions and identify the direction of major market trends and the likely direction of individual stocks. Dow first used his theory to create the Dow Jones Industrial Index, the Dow Jones Real Index, now the Transportation Index, which were originally compiled by the Dow for the Wall Street Journal. Dow created these indexes because he felt they were an accurate reflection of the business conditions within the economy because they covered two major economic segments, industrial and rail. While these indices have changed over the last 100 years, the theory still applies to current market indices. Much of what we know today as technical analysis has its roots in Dow's work. For this reason, all traders using technical analysis should get to know the six basic tenets of Dow theory. Let us explore them. Dow theory, the six basic tenets. The first tenet, the averages discount everything. The idea that the market reflects every possible knowable factor that affects overall supply and demand is one of the basic premises of technical theory. The theory applies to market averages as well as it does to individual markets, and even makes allowances for acts of God. While the markets cannot anticipate events such as earthquakes and various other natural calamities, they quickly discount such occurrences and almost instantaneously assimilate their effects into the price action. The second tenet, the market has three trends. Dow defined an uptrend as a situation in which each successive rally closes higher than the previous rally high, and each successive rally low also closes higher than the previous rally low. In other words, an uptrend has a pattern of pricing peaks and troughs. The opposite situation, with successively lower peaks and troughs, defines a downtrend. Dow's definition has withstood the test of time and still forms the cornerstone of trend analysis. Let us now take a look at some examples. What you see on the screen right now is an uptrend, and I have denoted the rally highs as H1, H2, H3, and H4, and the rally lows as L1, L2, and L3. As you can see, the rally highs are going higher and higher. In the same manner, the rally lows are also getting higher and higher. This denotes an uptrend. To draw an uptrend line, I connected the rally low 1 to the rally low 3. Let us now take a look at a downtrend. The figure you see on this slide is a downtrend, and I have marked the rally highs as H1, H2, and H3, and the rally lows as L1, L2, L3, and L4. As you can observe, the rally highs are getting lower and lower and lower. In the same manner, the rally lows are getting lower and lower and lower. This denotes a downtrend. To draw the downtrend line, I have drawn a line connecting H1 and H3. Why H3, not H2? As we define the downtrend, it is a series of lower highs and lower lows. H3 is definitely lower than H2. That's why I connected H1 to H3. The next type of trend is the sideways or flat trend. Here you can see that the highs are on the same level, more or less, and the lows are on the same level also, more or less. This is a sideways or flat trend where no discernible uptrend or downward trend are present. Let us now go to the third tenet. Major trends have three phases. Dow focuses attention on primary or major trends, which are felt usually take place in three distinct phases: the accumulation phase, a public participation phase, and a distribution phase. The accumulation phase represents informed buying by the most astute investors. If the previous trend was down, then at this point, these astute investors recognize that the market has assimilated all the so-called bad news. The public participation phase, where most technical trend followers begin to participate, occurs when prices begin to advance rapidly and business news improves. The distribution phase takes place when newspapers begin to print increasingly bullish stories, when economic news is better than ever, and when speculative volume and public participation increase. During the last phase, the same informed investors began to accumulate near the bear market bottom when no one else wanted to buy, begin to distribute before anyone else starts selling. Let us leave this third tenet for now. We will discuss this more thoroughly when we take up Module 3, Trend Concepts. The fourth tenet, the averages must confirm each other. Dow, in referring to the industrial and real averages, meant that no important bull or bear market signal could take place unless both averages gave the same signal, thus confirming each other. He felt that both averages must exceed the previous secondary peak to confirm the inception or continuation of a bull market. He did not believe that the signals had to occur simultaneously, but recognized that a shorter length of time between the two signals provided strong confirmation. When the two averages diverged from one another, Dow assumed that the prior trend was still maintained. The fifth tenet, volume must confirm the trend. Dow recognized volume as a secondary but important factor in confirming price signals. Simply stated, volume should expand or increase in the direction of the major trend. In a major uptrend, volume would then increase as prices move higher and diminish as prices fall. In a downtrend, volume should increase as prices drop and diminish as they rally. Dow considered volume a secondary indicator. He bases actual buy and sell signals entirely on closing prices. Today's sophisticated volume indicators help determine whether volume is increasing or falling off. Savvy traders then compare this information to price action to see if the two are confirming each other. The sixth and the last tenet, a trend is assumed to be in effect until it gives definite signals that it has reversed. This tenet forms much of the foundation of modern trend following approaches. It relates a physical law to market movement, which states that an object in motion, in this case a trend, tends to continue in motion until some external force causes it to change direction. A number of technical tools are available to traders to assist in the difficult task of spotting reversal signals, including the study of support and resistance levels, price patterns, trend lines, and moving averages. Some indicators can provide even early warning signals of loss of momentum. All of that notwithstanding, the odds usually favor that the existing trend will continue. Technical analysis comprises the study and interpretation of market action to try and project future price trends. All the information we have comes from the past, and with it we use technical analysis to try to predict the future so that we can trade profitably. The stock chart is the weapon of choice for this type of analysis. This is the reason why technical analysts are often referred to as chartists. Fundamental analysis is the study of companies' financial details. Its purpose is to determine whether a company would make a good investment based on an assessment of its financial health, potential for profitability, growth prospects, and the value of the company compared to the price of its shares. The balance sheet, profit and loss statement, and cash flow statement are the focus of this type of analysis. Fundamental analysis can also include the consideration of the company's story. To examine a company's story, you look for what it does, how it makes its money, and how it is positioned to perform in the future given the current economic climate. Let us now compare these two types of analysis. No discussion on technical analysis versus fundamental analysis would be complete without considering the pros and the cons of each one. The advantages of technical analysis. Technical analysis is based on objective data. You can look at a stock chart and plainly see what's happening right now. You can see which direction the price is moving in. You can see how popular the stock is based on its volume characteristics. The disadvantages? Technical analysis doesn't care about the company behind the stock. You might want to know what industry the company is in, but apart from that, the underlying company isn't really a concern. The company might be carrying more debt than it can handle. Its revenues and cash flows might be weak, and it might not even be making a profit. Who knows? Technical analysis doesn't concern itself with such matters. In conclusion, for most investors, technical analysis is about timing your entries and exits. For traders using technical analysis exclusively, no fundamental analysis, they also use technical analysis to determine which stocks to buy. Fundamental analysis advantages. Fundamental analysis gives you an idea of what a company's future prospects are likely to be. Large institutional investors like to buy shares in companies with good fundamentals. The disadvantages are the timing of the financial statements used in fundamental analysis can sometimes cause problems. If you get the information too late, you might end up buying the stock after it leaves the buy zone. Also, do the numbers make sense? Do they tell a story? Or do they just add to the confusion? In conclusion, fundamental analysis is useful for stock selection. It isn't ideal for determining entry and exit points, and for this reason, it is mostly used by the long-term buy and hold crowd. Fundamental versus technical analysis, my personal opinion. Technical analysts scoff at fundamental analysis because it is based on delayed data and say that it is useless because everything has already been discounted by price action. On the other hand, fundamental analysts question the validity of the discipline of technical analysis to the point where they laugh at its practitioners as pseudo experts. If I am not mistaken, I think almost all members of forums and Facebook groups are technical analysts or chartists. I have seen only a few posts focusing mainly on Benjamin Graham's test from the book The Intelligent Investor. I am neither for nor against fundamental and technical analysis. In my opinion, both are useful. In my case, I use fundamental analysis first, financial ratios, then horizontal and vertical analysis to test the soundness of the company I plan to trade. After determining that the company is fundamentally good, then I apply technical analysis to determine proper timing to enter the trade. Since I use both fundamental analysis and technical analysis before entering a trade on all stocks, I think this is the reason why my portfolio consists of 80% blue chips and only 20% speculatives. Okay, I think that would be all for now. Next time we're going to handle module number 2, charting basics, and we'll look at price charts, candlesticks, and trend lines. Until then, take care, and I wish you the best in your learning journey, and good luck on all your trades.